What if I told you that a conflict thousands of miles away could impact the price you pay at the gas station? Intrigued? Let's dive into it. Imagine a world interconnected in the most intricate ways, where a single drop of oil can ripple across the globe, causing waves in markets far and wide. This is the story of a recent 2% drop in oil prices, a story that begins in the heart of the Middle East conflict between Israel and Hamas. Diplomatic efforts are underway to ease this conflict, with European Union leaders calling for a humanitarian pause. This pause is not just about halting the violence, it's about allowing crucial aid to reach Palestinians in Gaza. Aid convoys have even started arriving in Gaza from Egypt, signaling a glimmer of hope amidst the chaos. This glimmer of hope, this perceived reduction in imminent risk to oil supply, has had a tangible impact. The oil market responded with a 2% drop in prices, a seemingly small figure that, in the grand scheme of things, can mean billions of dollars. But this story doesn't end here. In a surprising turn of events, the Palestinian Hamas militant group released 2 female civilian captives, further easing tensions in the region. Amidst ongoing Israeli airstrikes, the potential impact of supply disruptions in the Middle East on global oil prices and inflation is a significant concern. Then, from across the Atlantic, U.S. President Joe Biden announced the suspension of sanctions on Venezuela. This move could increase Venezuelan crude exports, but the full impact on supply risks in the Middle East remains uncertain. So, a slight ease in geopolitical tension can cause a ripple effect on the global oil market. But what happens when we add a wild card like Venezuela into the mix? Enter Venezuela, a country with vast oil reserves but crippled by sanctions. What happens when the sanctions lift? Well, that's the million-dollar question. U.S. President Joe Biden recently announced the suspension of sanctions on Venezuela, a decision that could potentially cause a seismic shift in the global oil market. Venezuela, once a titan in the world of oil, has been held back by crippling sanctions. This South American nation boasts the world's largest proven oil reserves, even surpassing Saudi Arabia. Yet for years, it's been like a giant asleep, its potential untapped due to political and economic turmoil. With sanctions lifted, Venezuela could stage a comeback. Its crude exports could significantly increase, adding a fresh supply of oil to the global market. This could ease concerns over supply risks, particularly in the volatile Middle East. However, it's not as simple as flipping a switch. The Venezuelan oil industry has suffered greatly under the weight of economic sanctions and years of underinvestment. Reviving it will require significant effort, time, and most importantly, capital. So while the potential for increased exports is there, it's not an immediate fix. Moreover, the full impact of this decision on supply risks in the Middle East remains uncertain. The Middle East is a complex region, fraught with geopolitical tensions. And while Venezuela's oil might lessen the region's influence on the global oil market, it's unlikely to eliminate the risks entirely. So what we have here is the Venezuelan variable, a factor that could, in time, reshape the global oil market. But the road to recovery for Venezuela is long, and the impact of this variable is likely to unfold gradually. The Venezuelan variable adds a new dimension to the global oil market. But how does all this affect Wall Street? Picture this: oil prices are dropping, geopolitical tensions are easing, and Wall Street is having a mixed day. Curious? Let's explore. On a typical Monday on Wall Street, U.S. stocks had a mixed performance. The U.S. Treasury yields, those benchmarks of national debt, took a bit of a breather, decreasing from a sharp 5%. This shift gave investors a chance to redirect their magnifying glasses towards the upcoming slew of earnings reports and vital economic data. The S&P 500, that trusted mirror of the U.S. market, ended the day slightly in the red. However, the tech-heavy Nasdaq Composite Index, driven by those interest rate-sensitive momentum stocks, managed to buck the trend and rose. The old reliable Dow Jones Industrial Average, on the other hand, didn't have the best of days, recording its 4th consecutive daily decline. It's interesting how these interest rates play a significant role in the market, isn't it? There's uncertainty in the air about how much higher these rates may go. The Nasdaq saw the most substantial gains, while the Dow experienced a slight decrease. The S&P 500 closed below its 200-day moving average for the 2nd consecutive session, giving investors something to ponder. The upcoming week is expected to be a roller coaster ride with nearly one-third of S&P 500 companies set to report earnings. The big hitters include tech giants like Microsoft, Alphabet, Meta Platforms, and Amazon, along with major industrial companies such as General Motors, Ford Motor, and Boeing. In the stock market, the Dow Jones Industrial Average fell, the S&P 500 ended lower, and the Nasdaq Composite posted gains. Communication services saw the most significant gain, while energy shares experienced the largest drop. Geopolitical concerns related to the Israel-Hamas conflict still loom in the backdrop. A mixed day indeed. But remember, folks, the market's a marathon, not a sprint, and next week's earnings reports could change the game. Imagine you're an investor eagerly waiting for tech giants' earnings reports. Will they exceed expectations or will they disappoint? It's a nail-biter. We're talking about some serious heavy hitters here. Microsoft, Alphabet, Meta Platforms, Amazon, each a titan in its own right, and their performance can ripple through the entire market. And it's not just the tech sector that's under the microscope. Major industrial companies like General Motors, Ford Motor, and Boeing are also stepping up to the plate. These earnings reports are more than just numbers on a page. They're a snapshot of the company's health, a report card, if you will. And like a report card, they can either bring joy or spell disaster. So far, the majority of companies reporting earnings have exceeded expectations. That's a good sign, but it's not a guarantee. After all, past performance is not indicative of future results, as any seasoned investor will tell you. Analysts are predicting a 1.2% year-on-year growth in S&P 500 earnings for the July-September period. Not too shabby, but it's a smidge below the 1.6% growth projected earlier in the month. The market's a guessing game, and next week's earnings reports are the next big play. So, buckle up, investors, it's going to be a wild ride. So, we've talked about oil prices, geopolitical tensions, Wall Street's wobbles, and the anticipation of earnings reports. But what does it all mean? Well, picture this. The global economy is like a giant jigsaw puzzle. Each piece, whether it's oil prices, geopolitical events, or Wall Street's performance, fits together to create the big picture. Let's delve a little deeper. You see, oil prices don't just affect your trip to the gas station. They're a crucial barometer of economic health. When oil prices drop, it's often because demand is low, signaling a sluggish economy. On the flip side, high oil prices can indicate a thriving economy, but also raise concerns about inflation. And this is where Wall Street comes into play. Wall Street, the epicenter of the global financial market, reacts to these price fluctuations. When oil prices fall, energy stocks often follow suit, pulling down indices like the S&P 500. But remember, Wall Street isn't all about oil. It's also about earnings. Earnings reports are like report cards for companies. They give investors a glimpse into a company's health. Strong earnings can boost a company's stock, lifting the overall market. Conversely, weak earnings can drag a company and the broader market down. And let's not forget about the role of geopolitical tensions. Conflicts, like the one between Israel and Hamas, can disrupt oil supplies, causing prices to spike. This in turn can create a ripple effect, impacting Wall Street and the wider global economy. So as you can see, these elements are deeply interconnected. Changes in one area can send shockwaves through the others, affecting everything from the price you pay at the pump to your investment portfolio's performance. As we've seen, the world of finance is a complex web of interconnected events. So remember, next time you fill up your car, you're not just paying for gas, you're buying a piece of global geopolitics, Wall Street wobbles, and corporate earnings reports. Isn't that something to think about?